Hello, everyone. Ed Yardeni here in Long Island, where it's raining. Got a little bit colder compared to what we were experiencing a few days ago. A few days ago felt like an Indian summer. Had to kind of wear shorts and a light shirt, but now it's back to sweaters again. And the rain is kind of welcome here because it hasn't rained for a little while. But on the other hand, it seems as though the leaves fall off the trees a lot faster, so we have to take our fall pictures much more rapidly. As usual, Max has joined us. He's, believe it or not, he's actually a party boy when he's not sleeping. He likes to have fun, but he also likes to sleep. Somebody told me that King Charles Cavaliers are couch potato dogs because they like to sleep a lot, and you don't have to entertain them a lot. One of my relatives has one of those Australian sheep herding dogs, and they need to be exercised and played with all the time. So Max is perfect for my disposition. At any rate, speaking of dispositions, the market has a sour disposition right now. Clearly, things have not been going well. A lot of concerns in the market. Halloween's kind of started early this year. It started back on August 1st. The market, the S&P 500, peaked on July 31st. And then that day, the Treasury spooked the bond market by announcing that they would have to raise $1 trillion in their quarterly refunding. And maybe the Treasury will spook the bond market again because on Wednesday, while everybody's focusing on the Fed, the FOMC meeting that will end on Wednesday and the press conference that Fed Chair Powell will host on that day, the more important event might very well be the Treasury refunding announcement. But at this point, I think the bond market's kind of figured out that government spending relative to receipts is out of control, and so I don't think that the Treasury is going to surprise the market that much. At any rate, they're not going to want to surprise the market that much. So we'll see what they need to raise. But clearly, over the past 12 months through September, we've seen that the federal deficit has been effectively $2 trillion. The official number is $1.7 trillion, but because of the way that student loans are accounted for, it really was more like $2 trillion, which we all know is the largest absolute federal deficit on record that we've ever had, and certainly even adjusted for the business cycle. Usually you get your big deficits in recessions. You don't get them when the economy just blew out with a 4.9% growth rate in the third quarter. So that's something to be concerned about. Meanwhile, there is a Fed meeting on Tuesday and Wednesday. I, like everybody else, think that the Fed will hold off on raising rates. Let's not forget that it was just October 19th that Fed Chair Powell spoke at the New York Economics Club and had an interview there. And he sounded really quite hawkish. He did acknowledge that inflation's come down some, but he basically reiterated what he's been saying all along. It's still too high and the Fed needs to be restrictive. And he even said something to the effect of that he wasn't even sure if monetary policy is restrictive enough or been restrictive enough for long enough. There's two issues there. One is, are they restrictive enough in terms of the level of interest rates? And the next question is, if they are where they should be, how long are they going to keep it there to maintain that restrictiveness in order to bring inflation down? Well, I think more and more of us are coming to the conclusion that they're restrictive enough with 5.25% on the Fed funds rate. And certainly if they do what they say they're going to do, which is give us maybe 2 rate cuts next year, not 4 rate cuts, that would be restrictive enough. Meanwhile, Nick Timiraos of the Wall Street Journal is sort of the one of the Fed watchers that seems to have be pretty well plugged into the Fed. And he just wrote 2 articles on the Fed's thinking, both today and yesterday. Yesterday, the article was that the folks at the Fed are trying to understand whether it's possible to have strong growth and falling inflation. So I thought that was kind of a interesting take. It seems to suggest that maybe the Fed's coming around to a view that I have, which is growth isn't bad, isn't necessarily inflationary if it's based on productivity. And the productivity number we had for the second quarter was actually surprisingly strong. I think it was over 2%. And well, actually, on a quarter to quarter basis, it was a little over 3% at an annual rate. And now we're going to get on Thursday another productivity number for the third quarter. And given the strength of real GDP, 4.9% in the third quarter, we'll see how that plays with the relative strength in hours worked. But I think we are going to see another strong productivity number. So I'll take that. My happy story for the decade is that it'll be called the Roaring 2020s, if in fact we get a productivity boom, a productivity cycle boom, growth boom, this over the rest of the decade. And I still hold to that view. It's one of the few reasons we can hold on to for some optimism. That productivity will make a comeback, and that it is making a comeback. And then we're seeing anecdotally things like robotics and automations and artificial intelligence all coming together to provide the tools to increase productivity. But for the here and now, all that seems quite far away, delusionally to some people. But I think right now the focus obviously is on what can go wrong or what is going wrong in geopolitics and jitters about how much higher the bond yield is going to go. Again, Nick Timoreos wrote a piece on the Fed's thinking about growth yesterday. Today, the discussion apparently was the extent to which the increase in the bond yield is equivalent to an increase in the Fed funds rate. It clearly is. I mean, who wouldn't imagine that? The question is, what do you imagine that a 100 basis point increase in the bond yield is equivalent to in terms of an increase in the Fed funds rate? And the article says that some economists think 2 to 3%. Why not 4%? I mean, 100 basis point increase in the bond yield, that's, in my mind, 425 basis point increases in the Fed funds rate easily. And why wouldn't it be even more than that? I think the bond market, in many ways, is more important than what's going on in the short-term market in terms of the Fed funds rate. The Fed funds rate certainly influences what you get in money market funds, but there are very few people that borrow on an overnight basis. Obviously, it has an impact on the rest of the curve, but the rest of the curve also has a life of its own. It's not just dependent on what the Fed's doing, but it's also dependent on the perceptions of inflation and whether the perception of what the Fed is doing is on the right path. And of course, suddenly, we find that the bond market cares about supply and demand. I think that's been the case ever since the July 31 blowout announcement by the Treasury on how much they need to raise. So you put that all together, and I think the bond market's done a lot of damage here over the, since early August in terms of tightening monetary conditions. So I think from that's another reason for the Fed to cease and desist from raising short-term interest rates any further. Meanwhile, the bond market is focused on supply and demand, and the question is whether 5% is high enough to equilibrate the market to create enough demand for bonds in order to meet the supply of treasuries. I think so, but I don't know so, quite honestly. Clearly, this is a work in progress here. As you're probably sick of hearing it, I coined the phrase bond vigilantes back in the 1980s, which is when they were particularly relevant. That's when they were actually quite active. In the 90s, they didn't have to do much because Bill Clinton got the message and maintained a fairly disciplined fiscal policy. And then inflation moderated dramatically. So we really haven't seen the bond vigilantes at work for quite some time. Maybe we could go back to Greece in 2010 when the bond yield went up to 40%. I mean, clearly, in a debt crisis, when people really lose their confidence in a government and the sovereign debt of a country, anything goes. It may be viewed as basically risk-free credit during normal times, but during abnormal times, suddenly you're going to have a real spike in the bond yield. I think that's Ray Dalio's. I don't want to put words in his mouth, but Ray Dalio has been talking about a debt crisis in the U.S., and I think the idea is that there's just too much debt outstanding, and there's even more debt being issued, and the bond market says no mas. And I don't know that he's ever used the term bond vigilantes, but that the bond vigilantes really conclude that the only way to bring law and order to fiscal policy is to push yields up to levels that get the attention of politicians. That clearly hasn't happened so far. And so that's where the risks lie, and that's where the jitters are in the bond market. Having said all that, I kind of agree with the cover story of Barron's that bonds are very attractive here at a 5% rate, especially if it turns out that inflation was to a large extent transitory after all. It certainly has turned out to be transitory when it comes to goods, less so in services. But I want to make a point here on inflation. There's a lot of people that are slicing and dicing the inflation every which way and coming up with reasons to be very concerned when they look at some of the components. But from the Fed's perspective, they should really be looking at the overall inflation rate. And if the overall inflation rate is moderating, then they're achieving their objective. And they shouldn't be too concerned about things like the super core inflation rate. And I think inflation is overall moderating. And I think what will keep it moderating is that in the services area, we'll see the shelter inflation rate continue to come down probably more meaningfully in coming months. So with all that, let's turn to some of the charts to be a little bit more specific about some of these points. So let's go share the charts. Let me take a little swig of water here. All righty. So these are our new charts that we're slowly rolling in. Basically, on weekends, we have more leisure time to make sure that they all are working all right and they look good. So you'll still see some of the charts with the yellow backgrounds for a while, but certainly before the end of the year, we're going to cut over to these charts. Just let me know by your Q&A if for some reason you're not seeing them well. I'm still a newbie at all this. I keep screwing things up. Thanks to my trusty Yeti microphone, looks like I finally got the audio working pretty well. But I noticed that sometimes my charts maybe look something like this, where you see the charts, but not the dates. So here goes. Stock market's not happy. We know that the breadth has been a real issue here, and this is the S&P 500 equal weighted. It certainly looks pretty bad. It's cut through its 200-day moving average a while ago, whereas the S&P 500 just recently cut through its 200-day moving average, went into correction territory on Friday. Maybe now it's trying to get away from there, but there's certainly, technically speaking, the market's not overbought. It's on the other hand, it may not be oversold enough. We are not seeing clearly just enough pessimism just yet, but we could get there pretty quickly within the next week or two and set ourselves up for a year-end rally. Why would we possibly have a year-end rally? Well, for the same reasons I've been arguing for a little while here, and that is earnings are coming in better than expected. Not for every company. I mean, Google and Facebook disappointed, but some of the other mega cap 8 certainly came out with better than expected earnings. And overall, we're expecting that S&P 500 earnings, when all is said and done, are going to come in with perhaps a new record high for that number, going into still higher territory in the fourth quarter. So we've got a situation now where the earnings picture is actually turning brighter. What's turned darker is the valuation story, because people are kind of looking at a 5% bond yield and saying, why are we paying? Well, why were we paying a 20 PE? Now, why are we paying something like 17 PE? Now, keep in mind that 17, 18 PE has been bolstered by the mega cap 8. Without that, we're probably kind of at 15, 16 on the forward PEs, which is historically a fair value level. And I don't see it going below that in an environment where I still don't see a recession. I have been raising the odds of a recession. In October, we raised it from 20% to 35%. largely because of the uncertainties created by the war in the Middle East. Usually wars in the Middle East that lead to ceasefires pretty quickly, but this one looks like it's going to last a while longer, and we've got potential for it spreading. So that's the concern there. And of course, the bond market needs to settle down for a little while here, and I think it's starting to work on that. The Nasdaq has been sort of only recently crossed through its 200-day moving average, but on the other hand, technology has been leading the sell-off here. We still view it as a correction. The market, the bond market, has been concerned also about stronger than expected economic growth, and we see that in the Citigroup Economic Surprise Index. It's been on the high side for a while here. There is a decent correlation between the Citigroup Economic Surprise Index and the 13-week change in the 10-year bond yield. So again, this has been a bearish factor in the marketplace because the knee-jerk reaction in the bond market is growth is bad if you're trying to get inflation down. But what we've actually observed is that growth has been surprisingly strong, and yet inflation's continued to moderate. And again, I think we may actually be seeing some signs that productivity is making a comeback. Productivity, as I discussed before, was making a comeback from late 2015 right to before the pandemic. It went from 0.5% at an annual rate on a 20-quarter moving average basis, kind of getting the long-term trend in productivity. So it was down to 0.5%. Now it's before the pandemic, it tripled. It went up to 1.5%. Then the pandemic threw everything off. People quitting, pandemic quits obviously depressed productivity. But things are settling down now. Quits rates are coming down. It looks as though productivity may be making a comeback here. So, I think the bond market, people have asked me, is this kind of a long-term bear market? I'm not convinced that it is. I think the bear market has repriced bond yields very effectively in a very short period of time. This was the so-called period of when the Fed was being very it kept the bond yields down because it kept interest rates down. So the Feds basically manipulated the bond market in this environment. Now the Fed stepped away and actually through QT is basically getting out of the bond market management business. And so we've had this tremendous increase to 5%. If you look, the last time we had something like that was back in the late 70s, and that led to two recessions. Maybe this time won't be different, but I think it will, because I think inflation isn't quite what it was back then. On the bond vigilantes, this is the bond vigilantes model in just one chart. You can see that the 10-year bond yield is the red line, and the blue line is the year-over-year percent change in nominal GDP. And during the period of the 60s and the 70s, the bond investors were kind of clueless about what was going on with inflation, and they knew it was going higher, but they kept buying these bonds deals well below inflation, well below nominal GDP. And there was a fellow by the name of Henry Kaufman who was a real rock star back then. He was very bearish on bonds. I think sometime in 1980 or so, Salomon Brothers held a meeting for him with Solomon's accounts at the Waldorf Astoria, and he had 2,000 people in the room, and it was broadcast to other clients around the world. And basically, he said there's just way too much debt out there, and inflation's too high, and you shouldn't be in the bond market. And people finally listened to him right at the tail end of the bear market in bonds. And ever since that period, for some time after that period, the bond yield stayed above nominal GDP. And here's the bond vigilantes at work. The bond yield went up, nominal GDP went down. Bond yield went up, nominal GDP went down. Bond yield went up, nominal GDP went down. It was in the 1990s that Clinton recognized that the bond yields, that the bond vigilantes were powerful. Now they're more powerful than ever when you consider how much more debt there is out there. But the bond vigilantes went to sleep. There was long kind of hibernation siesta in the late 1990s, right through this period of jerry-rigging the bond market by the Fed, and everything was kind of quiet. And the bond vigilantes, nobody talked much about them except in 2010. I got a call from a reporter asking me if the bond vigilantes were in Greece, and I said, yes, they are. Well, the bond vigilantes have made a comeback. If you Google search it, you'll see that references to bond vigilantes have increased quite dramatically. But now the bond yield has been rising and is still below nominal GDP, which is 6.3%. So the question is, are we going to go to 6, 7, 8% to get over nominal GDP, or is nominal GDP growth going to slow as real growth slows? It's kind of hard to imagine the 4.9% is a sustainable growth rate in the economy for now. I don't mind it. That would be presumably based on productivity, which would help to bring inflation down. But I think a big part of the slowing down in nominal GDP, in my perspective, from my perspective, is going to be on inflation, and vigilantes can take a rest here and enjoy 5% yields relative to an inflation rate that I think is coming down, is already down to 3% in many ways, and may very well still come down to 2%, which a lot of people still think is not plausible. Let's go back to the growth of the economy and the consumer. And I think it's important to recognize that one of the reasons the consumers are doing well is that if you take wages and salaries, about half of that, the equivalent of half of that is in other sorts of sources of income, which are all at record highs: interest income, dividend income. Let me make sure the thing is there. Interest, dividend, proprietors' income, rental income, all at record highs. They add up to over $6 trillion. And the wages and salaries add up to about $12 trillion at an annual rate. And a lot of retiring people, baby boomers, older people, seniors, guess what? They're living on this. They're spending this money. And we just saw that the savings rate has continued to decline. And that's what happens when you retire. You save less. And so that may account for some of the strength of the consumer. Speaking of the consumers again, this is kind of I think, a fairly clever chart that we devised. If I do say so myself, this is real consumption on goods divided by real consumption of services. And you can really see the extent to which consumers went on a goods buying binge during the lockdowns and after the lockdowns for a while through March 2021. And that was because they got cabin fever from the lockdowns. They wanted to go spend money. They had a lot of money, and they couldn't really buy services because they were still restricted by social distancing restrictions. So they piled into goods. And now when you take that ratio since March 2021, you can see that there's been a rolling recession in the goods sector as they pivoted away to spending more on services. Now it's kind of flat. And now they may very well start to spend a little bit more on goods and continue to spend on services. So just a more balanced consumer outlook, if you will. In terms of the rolling recession in the goods sector, there's some evidence here that it's bottomed. This is the regional, let's start with the national composite MPMI, and you can see that the manufacturing PMI has been gradually moving higher. That's the blue line, I should point out, but it's still below 50. And then the red line is the regional composite for 4 of the 5 business surveys we have. The Dallas came out today, but that certainly looks like it's bottoming. Consumers' sentiment was down in September because gasoline prices went up in September, but recently we've seen gasoline prices coming back down. So I think some of that, and that's also, by the way, affected consumers' short-term inflationary expectations. Let's have a look at that. Here's the expected inflation rate as compiled by the Survey Research Center, the same people who put out the survey, the Consumer Sentiment Index, and the FRB New York Consumer Survey. And you can see this is a little bit troubling that the 1 year ahead inflation rate as calculated by the SRC jumped up to 4.2%, but it can be volatile. And I think this is largely gasoline. It's the 1 year. The 5 year is still fairly well anchored. It's both of them were around 3%. So I think the Fed can take some comfort in this and be a little bit concerned about that, but recognizing that that's probably gasoline. Let's talk about inflation. Inflation continues to moderate. This is the core inflation rate down to 3.7%. It's also moderated quite a bit on the headline basis to 3.4. Here was that gasoline price uptick, but this is encouraging, and it certainly looks fairly symmetrical and I think relatively transitory. I know some people are worrying about another peak, but that's not our scenario. This is goods inflation. The red line is PCED goods, personal consumption expenditures deflator. This is durable goods. This is non-durable goods. And you can see that they've all really had a very transitory spike here. The problem has been in rent inflation. The rent inflation is taking its sweet time coming down, but it is heading in the right direction and is likely to continue down. The super core inflation rate, something that Powell introduced a few months ago, that's still somewhat worrisome. It's 4 this is the PCED super core, 4.3%. It's down a bit, still kind of sticky, but there's something called CPI services less rent of shelter, which is more volatile, but it certainly suggests that there's more downward pressure in that regard. So I covered a lot of different subjects rather quickly here. Let's take a few questions here from the audience. Let me change to my reading glasses since I have to read here. Okay, Joe, what are your thoughts on the implications of social media unionization for college campus students? This morning, and the spread, something in the journal this morning, and the spread of this as it relates to wage inflation. I'm going to read that article. I didn't really see it. I guess since the unions have been somewhat successful, there's obviously more people are thinking maybe we should unionize in order to get higher wage increases. At this point, the data we have for 2022 shows that unions accounted for only 6% of the of employment. Back in the 70s, when they really when union contracts really contributed to the wage price spiral, they were more like 35%. So I know the headlines are they're not disquieting to the workers, but they're disquieting to macroeconomists and Fed officials who are concerned about wage inflation. But I think wage inflation is going to continue to moderate, and I think part of that is perversely because there's a shortage of labor. And I think the way that companies increasingly are going to deal with that is by enhancing productivity with automation, in which case wages will still go up, and they'll go up faster than prices. As a matter of fact, the only way wages can rise faster than prices on a sustainable basis is if productivity makes a comeback. So I still have a win-win scenario for workers, for corporations, for the inflation outlook, and so on. Paul, good morning, Ed. If shelter costs are keeping the CPI over 2%, higher rates are having the opposite effect on real estate prices, given all the low mortgages out there that are keeping folks from selling and providing inventory. Yeah, that's a very interesting housing market out there. We are seeing signs that of a glut of multifamily units being constructed. The multifamily housing starts have actually been weak for the past couple of months, I think August and September. And anecdotally, we're hearing some signs that that's the case. And we're definitely seeing that in the Zillow and apartment list inflation rates for rent. They've really come down rather substantially. On the other hand, home prices have stayed up. They've come down some, but they've stayed relatively elevated because there's a shortage of housing. People have stayed home when their mortgages, when they locked in mortgages at record lows. But home prices aren't what get into the CPI. It's basically rents, and so rent inflation is continuing to moderate. I'll take a couple more here. Okay. Joshua said he likes the white background better. I'm glad to hear that. And the charts. Figure 12, outline the current directions of durable and non-durables. A bit difficult to see on the chart. Please clarify. Okay, well, we don't have time for me to go back there. You can look at it in the morning briefing, but the basic story I told in a New York Second was that we are seeing that durable goods inflation is now negative. I think it's minus 2%, which is what durable goods inflation did before the pandemic. It deflated us at a relatively slow pace, but it deflated. Non-durable goods hard to predict because that's food and energy, and food and energy has also come down substantially on the inflation rate, not in terms of what you're paying at the grocery store, but in terms of how quickly those prices are going up. So just take a look and you'll see what I mean. Peter, look, that was Peter. Ian, if you look out 1 to 2 years from today, what's your guess on the inflation rate and the 10-year bond yield? Well, I think we're probably back to a more normal environment for the bond yield, which means 4.5% to 5% is probably the bond yield that we're going to see for a while. It's what we had before the great financial crisis, before we had the new abnormal from the great financial crisis to the great virus crisis. So 4.5%, 5% kind of makes sense. And it's kind of consistent with what the real cost of capital should be. The real cost, of course, being influenced by inflation. And I'm optimistic. I know that some people think that it's not likely that we'll see inflation coming back down to 2%, but I think that could very well happen. And, you know, the CPI, as I've pointed out previously, for September, take out shelter and the CPI is up 2% year over year, 2%. Take out food and energy and shelter and you get 2%. So a lot of the problem here is shelter, and shelter inflation is coming down. Well, I hope the market doesn't come down this week. I can't make any promises here. We're overdue for at least a pause, if not a bit of a rebound here. But there are things to be concerned about in the short term here. Let's see if the market proves resilient, as I think it will. And we'll do this again next week. Thank you all for tuning in. Appreciate it.